Assalamualaikum, my name is Najah binti Maknatar. I'm from group RBA2423A. I will explain about determining optimal capital structure. First of all, what is capital structure? Capital structure is the amount of debt and equity used by a firm to finance its overall operations and growth. Meanwhile, optimal capital structure is a proportion of debt and equity that maximizes a firm's market value while minimizing its cost of capital. Next, how to determine optimal capital structure. There are many ways, but I will explain only three. The first one is weighted average cost of capital, WACC. The company need to determine the market structure that maximizes a firm's market value while minimizing its cost of capital. The optimal capital structure should be in the lowest WACC. The lower the cost of capital, the greater the present value of the firm's future cash flows, discounted by WACC. Secondly, risk and expected return. The company may issue more debt or equity while deciding on optimal capital structure. They will face trade-offs because debt issuance has a lower cost than equity and has tax advantages. The default risk rises at higher level of debts, resulting in investors will require a higher return. The optimal capital structure involves in using sufficient equity financing to reduce the default risk associated with debt. Lastly, industry averages. The company compares the amount of leverage other businesses in the same industry are currently using with the assumption that these other companies are operating with optimal capital structure.
Hi, my name is Nurfahana binti Muhammad Fauzi Al-Sani and I am presenting content 2.2. Factor affecting capital structure. The first one is government policy. Government create rules and framework run by businesses. From time to time, government change this rule and framework, forcing businesses to change the way they operate. The second is cost of floating. The cost of floating equity is significantly higher than the cost of floating debt. This may persuade the finance manager to choose debt financing as the less expensive choice. Last one is capital requirement. The entire quantity of cash required by the firm to reach its profit target is referred to as capital need. This is calculated by summing the funding and startup costs and investment. Factor affecting capital structure decision. First one is business risk. A company with a high level of business risk prefer to have low amount of debt since its earnings are more volatile. Second is taxes. The dividend payable on equity share capital and preference share capital is not deductible under the rules of the Income Tax Act, resulting in the high cost of equity funds. And the last but not least is financial flexibility. Availability of the company restructures the capital from equity to debt financing.
Hi, Assalamualaikum. My name is Haja Ashrani binti Azman. Now, I want to share about financial distress. Okay, financial distress happen when a company is unable to pay its creditors and lenders. This condition is more likely when a business is heavily in debt, or its per unit profit level is low, or the break-even point is high. Okay, to get out of this situation, the manager may be forced to sell the asset quickly, or they can lend their own money to the business and limit their discretionary spending. When a business is in financial distress, other party will often take the following step to reduce their risk in relation to that business. Okay, one option is for a supplier to insist on the return of any unpaid inventory. Suppliers may also require that any additional payment be made with cash on delivery terms. Supplier could also start to charge interest and penalty on overdue payable. Even a well-managed business might experience a time of financial distress because financial distress may develop for a variety of causes, some of which are totally beyond of a company control. For example, unexpected downturn in the broader economy may result in a significant decline in a company's revenue. Okay, that's all for me. Thank you.
Assalamualaikum. My name is Anissa Hafiza binti Abdul Rahim and my matrix number is 2021813212. Next part is discuss the integration of tax effects and financial cost distress. The integration of tax effects is a trade-off between the tax advantage of debt and the cost of financial distress. It is difficult to express this with a precise and rigorous formula. Besides, distress cost refers to the expense that a firm in financial distress faces beyond the cost of doing business, such as a higher cost of capital. Companies that are in the financial hardship have a harder time to completing their financial responsibilities, which increases the risk of default. Distress costs may include the need to swiftly and at a loss liquidate assets to meet immediate necessities. Moreover, financial cost distress may occur when a business or individual unable to create income because they are unable to pay its financial obligations. Next, let's move to the graph. This graph is a trade-off between the cost of financial distress and interest tax shelters. A graphic representation of the trade-off theory is available. The starting point is the value of the all equity. The red line is then created by multiplying the present value of tax shelters by the number of tax shelters. It is worth noting that PV initially increased as the firm borrows more. Additional borrowing repeatedly raises the likelihood of financial distress. Furthermore, the firm cannot be certain of receiving the full tax benefits it borrows excessively, as it taxes positive earnings to save corporate taxes. The cost of financial distress is assumed to rise in a direct proportion to the debt level. The graph shows the cost of financial distress as the difference between the red and the blue curves. As a result, the blue curve depicts firm value as a function of debt level. Furthermore, as the graph indicates, an optimal debt policy exists that maximizes firm value.
Assalamualaikum. My name is Mio Zuhilmi bin Mio Sulaiman from RBA2423A. I will discuss about agency cost of equity. The definition of agency cost of equity is the conflict of interest that emerges between management and shareholder. When management makes decisions that are not in the best interest of the company, and that shareholders perceive as actions that will not increase the value of their shares, an agency cost of equity arise. For example, management of the company may believe that a merger is the ideal step forward for the company, but shareholders may believe that the merger will not help the company expand, and that the money spent on the merger would be better spent on dividends and other investments. The agency cost of equity would be the cost of opposing the merger, such as lobbying. Second, how to minimize the agency cost. Taking steps to encourage an agent to behave in the best interest of the principal may also help to overcome the challenges associated with agency expenses. Performance-based compensation such as profit sharing or stock options, or even a wide range of non-monetary incentives, for example, may be effective in motivating management to act in principal's best interest. Stock options, on the other hand, would link management with shareholders rather than bondholders, lowering the agency cost of equity while raising the agency cost of debt. Ensure that the management and the business to budget planning, perform accurate accounting, implement limits on business expenses such as when traveling, and initiatives to increase employee satisfaction, which would reduce costs related to employee turnover, are just a few ways to ensure that agency cost of equity are reduced. The conclusion from this topic is every organization has an agency cost. These expenses are detrimental to the company and its stockholders. As a result, it is the responsibility of business owners and managers to make informed decisions. These expenses can be avoided if management is proactive and willing to act quickly in the event of a problem inside the company. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nurullah binti Muhammad Rizwan. Today I will discuss about pecking order theory. Okay, basically pecking order is originated from a life fact, which is in the animal kingdom, the strongest rise to the top. So it is about hierarchy. When talking about the pecking order theory, is about hierarchy. Okay, under this theory, it helps the company to firstly choose to finance itself internally by using the retained earning. Okay, why it is a first choice? Because it includes no cost of debt or cost of equity to be accounted for. If the company is able to finance itself internally, it means that the company's financial management is strong. Instead, if the company isn't able to finance itself internally, that financing would be the second choice. Okay, this second choice is associating with the debt capital. Okay, it is becoming the second choice because a company might pay some interest or making the cost of the debt is higher, which is compared to the cost of retained earning. If it using retained earning, it might not that higher as compared to the debt financing. So if it is able to finance itself through debt financing, it means that the management of the company is confident about the company's ability to meet its monthly obligation. Lastly, under pecking order theory, equity financing would be the third choice. It is becoming the third choice because it includes the most expensive financing option. Why? Because if, let's say, the cost of stock shares financing is higher as compared to the cost of debt financing, so it is including the most expensive financial option. Okay, and it indicates that the company is overvalued the stocks, or it is a negative signal. It is a way they have to choose because they are not confident about the stock's price or profitability of the stocks that they own right now. So that's all.
The last one is signaling hypothesis. Signaling theory can be defined as the belief that information on a company's financial health is unavailable to all parties in a market at the same time. In other words, it could be described as the behavior when two parties, individuals or organizations, have access to different informations. Typically, one party, the sender, must choose whether and how to communicate or signal the information, and the other party, the receiver, must choose on how to interpret the signal. Firstly, technical analysis-based signals. Technical analysis comprises of readily available data such as price, volume, volatility, timing, and derivative pricing. It is much easier to define and research market signals that lead to inference about potential price move in securities. For example, the price of security can be analyzed using candlestick patterns to predict future price movement. Secondly, insider information as signals. Insider information is a non-public fact that gives traders an advantage when trading the company's stock. Insider information is usually obtained by a person who is an employee or an executive of the company. Insiders at the company should have a comprehensive and wider knowledge of the business and its outlook, which can attract outside investors for their trading activities and can provide helpful insights into the value of the company's stock. Lastly, dividends as signals. When dividend payout increases, it will paint a positive outlook for the company's financial and future stock price. A decrease in dividend payouts may indicate expected hardships for the company's financial. The dividend signaling theory means the companies that pay the highest dividends will be more profitable.